Learning about gross profit ratio. So gross profit ratio is also one of the kind of profitability ratio. The profitability ratio measures the profitability or the operational efficiency of the firm. Then this ratio reflects the final results of the business operation. The results of the firm can be evaluated in terms of its earning with reference to given level of assets or sales or owner's interest. Therefore, profitability ratios are broadly classified into three categories. Profitability ratio required for analysis from owner's point of view, profitability ratios based on assets and investment, and profitability ratio based on sales of the firm. So in this case, gross profit ratio is a profitability ratio based on sales of the firm. Okay, so as the name itself suggests, gross profit ratio is equal to, it is also known as gross profit margin. Okay, gross profit upon sales into 100. Okay, so this ratio is used to compare a department profitability or a product profitability. Okay, if the costs are classified suitably into fixed and variable elements, then instead of gross profit ratio, one can also find PV ratio. What is a PV ratio? Sales minus variable cost upon sales into 100. So since the fixed cost is same, okay, whenever the sales minus variable cost ratio is higher, your gross profit ratio will also be higher. Now we'll see one example and calculate a gross profit ratio. So given below is the profit and loss account of Sevak Limited. Okay, you have profit and loss account for the year ended 31st March 2017. In that debit side of profit and loss, we have to opening stock, to raw materials consumed, then to wages and salaries, to manufacturing expenses. Okay, and credit side we have sales, net of excise is 12 crores, closing stock 75 lakhs. Okay, and then to gross profit 4 crores 75 lakh, then the total comes to 12 crore 75 lakhs. Okay, then this gross profit is carried down 4 crore 75 lakhs on the credit side of profit and loss account. Then we have miscellaneous income 50,000, profit on sale of investments 50,000, by interest dividend from investments 1 lakh, total is 4 crore 77 lakhs. Then on debit side we have to salaries 50 lakhs, to stationaries 2 lakhs, to printing advertisements 4 lakh, to postage telephone 50,000, to electricity 50,000, to selling and distribution 1 lakh, to interest 90 lakh. So to net profit is 3 crore 29 lakh. Now we'll find out your gross profit ratio. So your gross profit ratio is gross profit upon sales into 100. So that comes to 4 crore 75 lakh divided by 12 crore. So 4 crore 75 lakh divided by 12 crores into 100. So it comes to, let's see, so it is 39.58%. so your gross profit margin or gross profit ratio is quite good. Okay, so 40% of your sales is a gross profit margin. Okay, so to evaluate you need to compare it with the industry standards and accordingly evaluate your ratio. This was about gross profit ratio. Thank you.